Hello folks, my name is Robert Childs with Financial Market Advisors. We are a credit repair, credit restoration company. We also do a lot of credit education for folks, especially amongst the realtor community, the mortgage community, and of course consumers every day for the past 20 years. I'd like to talk about today is how it can have an impact, especially in today's economy, and how lates and collection accounts, especially into folks losing their jobs, where they can't pay their bills on time. We're going to go through a several-part segment of credit. The first thing is that you will really want to make sure that you check your credit report at least 3, 4, or even 5 times a year. According to Fair Isaac, mistakes happen by at least 86% of the time, or let's say 9 times out of 10, there's something incorrect on your credit report. Recommend a website, annualcreditreport.com. Get a freebie once per year at no charge. That'll allow you to take a look at your credit report, or other websites like myfico.com or even mycreditkeeper.com, which is like a monitoring service allowing you to check your credit on a regular basis and make sure no mistakes on there. Even according to Fair Isaac, you have a 30-day late on a mortgage or credit card, you'd be looking at somewhere between a 5-point to a 20-point drop in your credit score as each 30-day occurs. Let alone a 60 or 90-day late can even do more. So it's imperative to check your credit at least once a quarter and check it again 30 days or more before you submit an application for a mortgage or even a refinance. Very crucial to know what's on your credit report at all times. With almost 8.5 of every 10 people in this country having mistakes on their credit report, even a mistake, even a $100 collection account can drop your score somewhere between 20 to 50 points. And if you don't know what's on your credit report and you haven't seen your credit report in, let's say, 2 years, for example, it's going to cost you points, higher mortgage payment, higher rate upon buying that house or even a refinance. So please, folks, check your credit as often as you can. What a credit score is a 3-digit scoring system known as your FICO score. It stands for Fair Isaac and Company. The United States adopted Fair Isaac back as early as 1975, but really was introduced to the whole community, banking system, etc., in 1980. By the latter part of the 80s, the whole bank system was actually on Fair Isaac. With all the mistakes that are actually on there as the population grows in the United States, folks moving from Europe and Asia, that it's impossible to monitor, the Bureau itself to monitor your own credit. Even under the Fair Credit Reporting Act laws, which was written by Congress as back as early as 1971, they say 3 primary things. Anything that's inaccurate, anything that's erroneous, like fraud, or thirdly, something that cannot be verified must be removed from your credit report. But guess what, guys? Because of the cost of the Bureau's cost of verification, they don't want to lift a finger or pick up the database to say, you know what, let's delete this and this if it's incorrect on John Smith or Jane Smith's report. It's up to you, Mr. Consumer, to know what's on there at all times. According to Fair Isaac, that cost on a daily basis, contact the bureaus, it costs them an average of 30 cents to do a verification. And according to Fair Isaac, you hear me say that a lot, according to Fair Isaac, there's 25 million people a day, 7 days a week, contacting the bureaus either through email, letters, phone calls, or some other type of electronic communication to say this is incorrect on my report. 25 million average times 30 cents. Add it up. So the bureaus can save millions of dollars a day by now lifting a finger on the older collection accounts that have been paid off, older lates, even recent stuff that's on your credit report. So please take it upon yourself to know what's on your credit report at all times. It will cost you. The 2 other key elements that are part of a higher FICO score are revolving credit and, of course, lates that we've been talking about. If you go to myfico.com, click on the education link, it'll give you a pie chart that will actually break down the content that we're talking about verbally today. The first one, lates. That makes up about 35% of a high or low FICO. A lot of people don't know that if you get paid here and your due dates are here, very close to each other, move your due dates on your credit cards, automobile loans, your student loans, so you won't have any long-term lates. Number 2 is revolving. Revolving actually would have a high ticket of success or a ticket of failure depending on how you handle that revolving debt. In other words, having low debt or paid off on a monthly basis is ideal. That's in a perfect world. According to Fair Isaac, you should have 34 or less % debt of your combined credit limits, not installment. I don't mean automobile loans or student loans, only revolving. Macy's, Nordstrom's, Sears, Visa, Mastercard combined, minor or major credit cards. And how you can figure out what your availability is, because the higher your total percentage availability is on revolving can give you a higher credit score. How you can figure it out is look at your recent credit report, add up all your revolving debt, add up all your combined revolving credit limits, divide the debt into the limits, that's your total percentage of availability. The higher that availability is, the better off you are. Here's something I bet you don't know. According to Fair Isaac, if you have a $2,000 credit card limit and you have $2,000 in debt on that Visa, nothing past due, no late, now $1 over or under, your $2,000 maxed out. If you carry that debt for 6 months or more, and you make the minimum payment on that debt for 6 months or more, Fair Isaac says you lose an average of 100 FICO points. Really, it's between 50 to 150 point loss, but it averages about a 100 point loss. Imagine going past due. That's even more bad icing on the cake. So if you imagine being down at zero in that $2,000 example and gaining back 100 FICO points, imagine going from a 605 to a 705 FICO score, that can make or break a really good real estate loan. So it's imperative to keep that as low as possible. Another issue that the credit card companies are now doing they are closing revolving accounts if you have not been using them, or better yet, they're reducing people's credit limits because of the economy. Even myself, I got excellent credit and I haven't seen a credit card offer in more than 2 years in my mailbox. So it's imperative to know that if your debt is very low, the chance of you being looked at by the bank, let alone your spending habits on those credit cards, are next to none. But if you have high revolving, and depending on what you're using those credit cards for, cash advances, paying mortgage payments, they might look at it, either close the account, let alone reducing your credit limit. So for example, if you have a $10,000 credit card limit and you have $5,000 in debt, you have a 50% availability. If the credit card company sees that, Paul is doing something about that credit card, and they lower your limit from $10,000 to $7,500, your availability shrunk from 50 to 25%. It's like on paper your debt went up even though it didn't in real life. There goes your credit score. So it's imperative to try to keep debt as low as possible and the limits as high as possible. Important about revolving. Also with revolving, there's a fourth element on what they call the key factors that affect one's credit score, is a length of credit history. This only makes up about 15% of a high or low score, but if you have an account that's 20 years ago and your second oldest revolving account is 10 years ago, there's a 10-year gap on the back end. If you close that oldest account, you lose that 10-year gap on the back end, damaging your credit score. How much? It's hard to say, between 20 to 50 points, maybe more, maybe less. So in a lot of cases, the major credit card companies, Visa, Mastercard, were not hesitant to want to close your account due to inactivity. The reason is, according to Fair Isaac, the major credit card companies, Visa, Mastercard, Discover, American Express, JCB, they pay $1 a year on average to the 3 credit bureaus, or $3 a year, to maintain that account opening. So if you're not using that, let's say that Bank of America credit card, why would they pay that $3 a year times 55 million customers? You see how it can add up. So how you force them to keep the account open? Use it at least 2 times a year. If it's an annual fee being charged, activity, or you charge, you buy a sandwich, you buy a tank of gas and pay it off. Keep it alive, especially if it's your oldest account. I've seen even major revolving accounts either closed by the consumer or the creditor where it has a zero balance on it, and it affects the person's availability because the account was closed, they lost length of credit history and height. Limit dropped, reducing their overall availability, hurting their credit score the next month. So force them to spend that $3 a year by using that credit card at least twice a year, and keep your debt low as possible. Very, very crucial, folks.